Welcome to Fintech Daydreaming, the podcast that dives into the world of banking technologies and the ever-changing landscape of fintech companies. We bring you real-life examples from global and local thought leaders, as well as experts working within the financial industry, and seek out the best stories from the front lines of financial services innovation, where dreams of industry pioneers meet reality. Hosted by Krogdahl and Ville Sointu. This is Fintech Daydreaming.
Hey listeners, and welcome back to another fantastic episode of Fintech Daydreaming. As always, I'm Paul Krogdahl. I'm going to be your host for this show, for this episode. And with me, I've got, as always, my fantastic friend, Ville Sointu, who's going to help me to keep me on the straight and narrow and honest as we go through a roller coaster ride of the world of embedded finance, open banking, platformification, and a fantastic move towards a future vision of banking. So Ville, how are you, my friend?
I'm good. It's the first full week of work after my summer break, even though we did a couple of episodes already of the podcast, which was always as much, even if you're still on vacation. But yeah, kind of getting up to speed. I guess what we say in Finland now is that it's now time to start preparing for Christmas, even though it's still August. But have to have something to wait for.
No, I start getting ready for Christmas on January 1st. I mean, Christmas is always something to look forward to. But today I'm even more excited. We've got with us Simon Torrance, who is a fantastic thought leader, entrepreneur, senior independent advisor. I mean, he's even done advisory for the World Economic Forum, which, I mean, to me, that is some real cool, interesting stuff. He has written a book. He has got something called the new Growth Playbook, all focused around helping organizations to get from old, stagnant, dying business models to a whole new world of platforms and platform business models. Something that I personally have got a big interest in. I am very passionate. Everybody knows that I repeatedly keep saying that I strongly believe the future of the banking industry will be dominated by platforms. I think we see this coming. It is huge. And I think, Simon, listening to some fantastic interviews that you've already done on YouTube, etc., and even checking out your videos around the new Growth Playbook, it sounds like you really also believe that platform business models are going to dominate business in the future. Yeah?
Well, yes, yeah, and because they're very appropriate for a digital world. And of course, the most successful companies today are all platform businesses. They're all software businesses. They've worked out how to create a platform business model, and they've become very successful. So my view is that every company needs to adopt and adapt some of that magic to their own business if they want to stay successful in this world.
So what is a platform business model? If you had please, share with us, what do you see as a platform business model?
Yeah, platform business model fundamentally says you don't have to do everything yourself to serve customers. So at one level, a simple example would be Uber. So Uber doesn't employ drivers. It doesn't own any cars. It just connects people who need a ride with people who are happy to give a ride. And it's a pure bit of software that matches those people up. So that's the purest example of a platform, pure software that connects people together, matches them, people who need something, people who've got something. Airbnb is another good example of that. In the another example from a traditional company would be Apple. So Apple used to make computers and then sell computers to people. Very expensive to do that. You need to build factories, lots of people, very high cost. And when it moved into mobile phones, it said, well, mobile phone we've created this great mobile phone, but people are going to be attracted to it if there are lots of applications that work really well on the phone. And so rather than them trying to come up with all the applications, they created an open marketplace, an app store for other people to create applications to serve their customers. And that drove demand for their core business, which was the phone. So that's an example of a traditional company applying a platform model to add value to customers and create a lot of value for itself in so doing. Yeah. So it's the notion of being an intermediary between people who want something and people who've got something, whether you create those solutions and or you work with others to do so.
So we're talking about a matchmaker basically, right?
Yes, yeah, fundamentally it is a matchmaker of nearly anything. So it could be software, physical products, could be ideas. I mean, all kinds of things. So matchmaking is one of the core elements of a successful platform business. Yes.
Okay. What do you think is preventing large organizations generally from adapting and adopting a platform business model or a platform strategy?
Well, there are a number of things. One is that it's very different to what they're used to doing. So, and I'll come back to that in a second. The second is it's completely software based. And if if you're running a company that isn't a software company, it's a difficult thing to conceive of, let alone create. And the third thing is the skills, the organizational skills. So you've got a core business that does a certain thing really well. It spent decades in many cases for a traditional company to grow its business, to become mature, to scale, and everything is focused on making that whole process more efficient and effective. And typically for most businesses, they operate what we might call a pipeline. They source raw materials, they create products, they distribute products to customers. It's a pipeline business. A platform, as I mentioned, is one where you don't have to do all that creation to add value to your customers. You act as an intermediary. And that whole way of thinking is very different. You need different skills, you need different attitudes, you need different metrics, and so on. So the people who run traditional companies have become successful by running what we might call a pipeline business. And they've never done a platform business before, and they don't know software typically. And therefore those combination of things means there are some very significant, not only mindset challenges, but also just basic skills challenges. And then you get to the organizational structure challenges as well. So that's fundamentally why it's very difficult for traditional companies to adopt that approach. And I should just say, it's also difficult for the companies that were the pioneers. So Apple, they had a lot of arguments internally about whether they should open up their app store to third parties. Even when they did that in 2008, and even Jeff Bezos with Amazon, when he wanted to create an open marketplace back in 2000, there were a lot of complaints from his colleagues that that would be cannibalizing our retail business. Why would we want to do that? So even those companies, the pioneers, they had to go through their own journey of understanding and change their mindsets to be able to move into this space. And then, of course, this great wave of startups which said that's a good model. Why don't we do it? Like Uber, like Airbnb, and other platform businesses. So I think those are the main reasons.
It's interesting when you discuss Apple and Amazon as large organizations that have struggled to sort of adapt and adopt into a platform business model, even though we've always seen them as being very innovative, very new, very agile. And then you move over into the banking industry. Banking as an industry, as a business model hasn't changed since the beginning. We're talking hundreds and hundreds of years of, the same structure, the same way of working, the same philosophy. And we're now saying that the world is going to be based on platforms. That's a fundamental mind shift for the leadership of any bank to have to go through. So what do you think is going to be the sort of success here for the banks to adopt this whole new way of working? And do you think that most banks will manage?
Second question is an interesting one. We'll start with the first one first. I think so. The challenge, as I said, is that all the bank's processes are about delivering the business model that has been successful for the last 150, maybe even more years. And so the only way, and I'll give you some good examples in a minute, the only way of creating a new business model like this, which is fundamentally different in nearly every aspect, is to create a separate space for it. Yeah. It's not going to happen within the core, not to start with at least, because you got all kinds of complaints about cannibalization and this is not how we do things and customers don't want this and all these reasons why it's too difficult and too risky and everything. And banks are very good at risk management and therefore, there's some downsides to that as well. So the only way of doing it is to create a separate space where, and I call this the ambidextrous organization, a place which has different people, completely different metrics, not at all like the metrics of the core bank, and different incentives for those people to create essentially a software, a multi-sided software business model. Mm-hmm. And so it has to be away from the core business. Now, there are various mechanisms. The other key thing is it can't be so distant that the core business thinks, well, why are we spending all this time and money over here? And why is this, this new business using all our assets, our distribution capabilities, it could be IT platforms and procurement. So the new business, the new platform business has to drive demand for the core business as well. Okay. So that everybody is happy. And I'll give you a really good example of how this is working, actually. One of the best examples is in Asia, mm-hmm. And it's just started with a bank. And I'd say, well, it's early days still, but it's Standard Chartered Bank. Mm-hmm. And it's one of the best examples of a bank who has really adopted this model, but in a way that is most likely to succeed. So it created a completely separate ventures unit called SC Ventures. And one of the ventures they created was a bank as a service platform. Yeah. Completely separate venture away from the core business. And that essentially, and this is coming on to our discussion about embedded finance, but this sells banking capabilities to third-party online marketplaces and digital businesses, so that those online marketplaces can embed banking services and other financial services into their propositions. Very, very attractive to them, and very attractive to this, essentially a startup for the bank, because they have 100 million consumers and 15 million merchants, big business there. So it's a completely separate software business. They've built their own tech stack, didn't use the core banking stack because it's terrible, built it from scratch, and they go directly to these new customers. But, and this is the really key thing, every time they create a digital wallet for a customer and a bank account to go with it, the bank account is provided by the local core business of Standard Chartered. So Standard Chartered core business go, hey, this is good. We're getting new deposits. We don't have to do anything here at all. We're getting into 100 million we might get, which is pretty good. We don't have to do anything. So we're happy. Yeah. And you've got this flourishing software business that actually, the leaders of it think it would be worth more than the core bank, in 3 or 5 years' time. Because and you see all these examples of fintech platform businesses being worth more than 100-year-old traditional banks. So that's a really good example of an example of a platform business and the way of executing, which gets over that hump of lack of skills, capabilities, metrics, etc., but also delivers value back to the core business, such that the core business will continue to support it, and you can create synergies between the two.
That's a fantastically good example. I'm wondering, Ville, you you're sitting with inside of Nordea, who's been hailed as one of the leading banks around open banking and driving a platform agenda. Any thoughts?
A few reflections. Actually reflecting back on one of the discussions we had last season on the podcast even, which was, if you kind of divide this kind of almost like the value chain of services being provided for financial services users, there's kind of the supply line. So how do you actually make the quote unquote product? And then there's the platform and how you make it available for people. And then there's distribution, which can be kind of connecting to maybe the next topic we're going to talk about, which is embedded finance. But if you kind of look to the supply chain side of things, and I think we talked about this production cycle in a way in the last season as well, which is that today most of the banks are working in this kind of product-driven world where you kind of manufacture everything in-house, and this is the equivalent of a car manufacturer having their own farm of cows in order to produce leather seats for their cars. Which of course doesn't make any sense from a car manufacturing standpoint, i.e. you buy these from suppliers and then it becomes a part of your whole value proposition, but it doesn't mean that you have to grow cows yourselves. And I think we're yet to see this full transformation from a banking perspective, moving from kind of combining several maybe external, partly internal products, like you Simon mentioned, into this kind of outcome-based business, which is part of the narrative around embedded finance. But I'm curious actually to talk about the kind of evolution towards embedded finance, especially in context of how open banking has been developing lately. Because that's actually one of the questions that we get a lot. I mean, we've been talking about PSD2 and open banking for so long time. Don't all the banks already have APIs available? Is this the same as embedded finance? And what actually defines embedded finance? Maybe Simon, you have a good view into this topic.
Yeah, absolutely. This is my big focus at the moment, because I did a project, actually a platform strategy project for a very large international European bank a couple of years ago. And all the problems that I described earlier on were there. But I looked at what type of business models were really taking off in the finance world, and embedded finance was one of those back then, and is now. I've then since done a lot of market research and analysis, and it's very exciting. But if we just describe what it is, so embedded finance, what it means is it's taking advantage of the developments in financial technology capability. So now, in theory, nearly any type of product, service, or capability can be abstracted into software and then be made available to any developer within any type of company to either make it part of their own customer proposition. It's like Lego bricks that they can then use to configure some new proposition, or it can be an add-on to a service. So it could be like, like a buy now, pay later, or insurance when you go to point of sale. So now financial technology has become so sophisticated that what I've just described in the past is very complicated, and you had to years of integration and doing sort of complex negotiations with banking or insurance partners. But now it's really easy. And just as we saw in telecoms and in software, IT originally, you're now having this new breed of what I call developer platforms that are sitting between the supply base of banks and insurers. They are taking through APIs, getting access to nearly any type of capability, and then making it very easy for developers and product creators within third-party businesses to then configure solutions that suit their customers, because they know their customers really well. They know them much better than the bank or the insurance company. Yeah. So the APIs are just an IT exposure capability, but it's what you do on top of that that is key. And it's attracted, and VC money has poured into this, a new breed of what I call developer platforms that are enabling people to take advantage of this. And in telecoms, we saw this with companies like Twilio, and not many people have heard of Twilio, but if you as a consumer interact with an enterprise over your phone or with messaging, it's organized. Twilio organizes that. They're a developer platform that lets enterprises interact with you using communications, and they connect all the telcos. And we're seeing the same with in the financial services sector. So that's essentially, if you like, what it is. And we can I can talk for a long time about the different sort of use cases, case studies, and the opportunities and threats to multiple parties. But just to your point, Ville, one thing about open banking is that open banking makes all of that work even better, because a brand or a digital platform will have a lot of data about their customers. And that's pretty good. If you can combine that with transactional data about the end user through open banking, consented open banking data, then you've got this treasure trove of data, which helps you to create more personalized, less risky, more affordable solutions for the end customer. I mean, it's great for the underwriters, because they've now got much more data that they can play with. And then it's great for those who are trying to create the solutions, because they can make them now much more relevant and personalized and cost effective.
Yeah, many things in this, actually, they're not the same, but they rhyme, right? I mean, in the same way as banks need to relook the way they build products or outcomes by combining several things together in order to kind of provide a better service, to become a platform. Now, with embedded finance, the banks who actually provide the financial services as part of the kind of workflow of the kind of, for example, e-commerce site, they are in a way being kind of one step ahead of kind of above that value chain, but in the same way providing only a partial thing as a full customer experience, i.e. the embedded finance part. So yeah, a lot of parallels there for sure, and it's an interesting kind of value chain to observe.
But there's also a double-edged sword here, right? We're talking on the one side about banks becoming platforms and driving platform business models. But on the other side, with embedded finance, we're talking about, a commodity-based business. We're talking about the banks basically becoming white-labeled services of generic capabilities that anyone can deliver. We saw that in telco. It basically means that the banks become focused on low margin, high volume transactions, rather than actually that close customer relationship that you would get with a platform, because they become embedded into the platform. So isn't there a dilemma here that the banks really need to figure out for themselves? Do they play in this commodity-based, low value, high volume game, or do they step into the platform business model game and try to position themselves as the orchestrator or matchmaker of the consumers and providers of the future?
Well, I think they need to do both, exactly that. So in that example from Standard Chartered is probably quite a good one. So in that case, they are a platform now. They are a developer platform serving this huge new market of digital marketplaces and e-commerce players. So they've now got a stake in the future there. They've got a software business which is a platform itself, and is enable them to enter a completely new market they would never be able to enter before. So that's very good. Now the core business, it also, because it's got lots of customers already, it will need absolutely to be a platform itself to retain its customers. Yeah. So a bit like Revolut is a good example of a fintech, which is it's probably one of the leading neobanks, which has got platform thinking embedded inside itself. It creates products really fast that tests them very quickly with its customers, and can offer a much broader range of products that are attractive to keep them sticky. Yeah. And then if you go to Russia, Tinkoff Bank is probably the best example in the world. It is voted the world's leading digital bank, I think, last year. It has a return on on equity of 56%, I think. It's just off the scale. Because it's not an ancient bank, it's relatively new, I think 20, 30 years old, but it has created around its core business a set of lifestyle services to keep its customers sticky. So it's a reason to stay with Tinkoff, because the more services you consume from them with a single sign-on and payments all embedded in the background, why would I go elsewhere? They're creating a version of a super app. And that's the sort of very, very powerful example of a platform business model or an ecosystem orchestration, which can be very successful. So, my bank is NatWest Bank in the UK, and they have nothing like what Tinkoff offers. And we'll come on and talk about, maybe you can tell me directly which direction you want to go in and what traditional banks need to do. But I think fundamentally they need to do both. Now, but they've got to overcome some of these organizational barriers, fundamental mindset, structures, metrics, incentives, which hold them back at the moment.
Paul, you said that this is a commodity business, so there's no differentiation whatsoever. But Simon, you mentioned that data, of course, is important here. The more data you have, the better risk controls you have. Do you think data would be the way to actually differentiate and be more competitive as part of this embedded finance landscape as a bank?
Well, it's a very good question. Yeah. So the more data you have, the more insights in theory you have, and therefore you can use those insights to provide products that meet unmet needs. That's what fintechs and startups are very good at doing. I have to say, banks have got all my transactional data. They don't need open banking. They've got it all already. My bank has that. Why do they? And yet they offer me nothing, apart from a big safe to put my cash in, although it's not even cash anymore. So I have zero affinity with my bank. I'm pretty confident they will keep it safe, but nothing else. And in fact, they created a loyalty rewards program recently, and it's on the homepage of my app. And I thought, I'll have a look at that. I've been with them for over 30 years. I must have picked up quite a few rewards. The sum total is £25.82 when I look at this.
Thank you for your loyalty.
Yeah.
Wow.
What am I getting?
Thank you for your custom.
If I want to redeem it, it'll take 30 days to redeem it. So so now somewhere in that app, it's also got, because the app's pretty good to use, I can check my balance and I can make transfers. That's banking 0.9 or something, I don't know. But it says, there's some offers here. So I go into offers. Okay, I'll just for sake of, I did it just before I came on this podcast, just so I could, because you asked for a joke, Paul. So maybe this is the joke. I've got another one later, but so the offers are good. So I can get credit. Oh, that's quite good. I get insurance and I can get a few other things. And I have to apply for those. So I have to fill in lots of forms to apply for them.
Yeah.
But they know what I do. They know all my purchasing behavior because I use their debit and credit card. But they have they've been trapped within the way that they think about the world. And that's because they are by nature risk managers. They are brilliant at risk management. That's why I keep my money safe with them. They are not innovators. They are not Revolut. They're not Tinkoff. They're not all the other. They're not, Klarna. Or, Klarna is now worth nearly double Deutsche Bank. Yes. But Deutsche Bank could have created Klarna. Nordea could have created Klarna. Has all the assets, and knowledge, and everything else, but it can't do that. So that example just illustrates the fundamental challenge. And it's, I'll just carry on with my train of thought here for a second. And it's not funny anymore because if you look at the economic profit of the largest banks in the world, I think the top 200 banks in the world, on average, they make negative economic profit. The economic profit is not what they publicly announced. It's profit after cost of capital. Yeah. So before COVID, in the 3 years before COVID, on average, the banking sector made huge negative economic profit. Now, with digitization accelerating all the pressures that it does on the sector, that's due to get even worse looking forward. So you've got this supply side, which is entirely broken. And that's what's creating the flood of fintech innovators and the flood of VC. It's entirely broken. There's apart from the fact, the people who run the banks are fat and happy because they've got a couple of years left on their career before they get, anyway, come back to that later. But it's entirely broken. And on the demand side, we have enormous protection gaps, enormous funding gaps. So we've got a financial system that is broken. People can't get access to affordable, relevant, personalized financial solutions. And the supply side is not making money delivering what it's doing at the moment. So that's where you need a reinvention of the business model of a financial solution provider. And that's why it's so imperative that things speed up now, because those pressures are getting bigger on both sides at the moment.
I think you mentioned something very, very critical in all of that, Simon. And it reminds me, Ville, of the discussion we had with Ewan earlier in one of our episodes around the fact that the key people in a bank that should be motivated to drive these changes aren't motivated to drive the changes because their current bonuses, etc., are tied to maintaining the current flow of business. And any large change that they implement, the rewards of that will come after they've retired or left or whatever else. So they're not motivated in any way to look past, the next 2-3 quarters. So it's exactly like you said, Simon. It's very difficult to change that whole fundamental mind shift in most banks to adopt to this new model based upon, what we're all used and comfortable with.
And yet it's quite easy to do. So, and this is the problem. So you've had obviously a lot of innovation theatre going on, as you know, a lot of hackathons, and we create sort of an office space. We get in startups to come and work with us, and most banks have gone through that, in the last 5 years, and it's delivered almost no real material impact because the economic profits are still so bad. But if you do the ambidextrous organization structure properly, then you can win. Like the example I gave from Standard Chartered, we're seeing this actually from Goldman Sachs with the creation of new ventures there, which are proving successful as well. Yeah. And there's some other, few other examples from other sectors. But unless you make that fundamental split, and it's not, and I'm going to talk a bit about the detail of it, then you won't get out of that problem you just described there. But to create the invent the future part of the business is not a huge investment. I mean, compared to all the money that they waste on sort of massive IT transformation projects, it's just sort of tiny in relatively. But it needs to be done not as theatre, but as a part of a real integrated strategy to grow the value of the business, not to learn, not just to learn, put it that way. At the moment, it's all about, well, let's learn a few things about digital stuff, and then we'll see what we could apply. So it needs to be done properly, and there needs to be a governance that means that this area has the right people with the right metrics, with the right incentives, that it has the ability to create completely separate ventures, like the one I mentioned with Standard Chartered, that can grow separately and then be reincorporated back in the business when they become mature. But that does allow the bank to create its own version of Klarna or Revolut, or even the bank as a service or embedded finance platforms or whatever. And until you do that and give it the same prestige within the bank as the core business, it doesn't have as much money by a tenfold amount, but it has the prestige, and it's governed in a way using the right metrics, with the proviso that whatever it does here is going to drive demand for the core business, And that's very clear to the core business as well, and part of the mandate. Unless you do that, then you won't make the change. And that's my biggest message at the moment. That's a fundamental enabler. And I don't see many banks and insurance companies doing that at the moment, and that's why they are. I mean, that's partly why they are suffering so much.
Yeah, I think it was actually Ewan who said that this is the so-called speedboat strategy. So basically, you break off the main kind of carrier, and then you kind of have your own agenda as the kind of the digital unit of the bank, and you're allowed to execute. We've seen many banks try this. I mean, SEB obviously seems to be one of the more successful ones here, at least for the moment. But we've also seen some fail. So we've seen JP Morgan and RBS both trying something like this and not being successful. What do you think, Simon, is the kind of key success or failure factors with this strategy?
Yeah, so it's governance. So throwing a little bit of money at something to test things out is not the approach. It's got to be there's all kinds of things related to it, but governance is the key one, and the method of execution has to be different than the core business as well. So one of the best examples in the world of a financial institution doing this very well is Ping An, which is an insurance company from China. And they said, to your point, Paul, they said, we're no longer an insurance company. We're going to be a technology business which happens to own financial service licenses.
Right.
That's it. They said that about 10 years ago. So already, my God, that's different. And they said that we want to be more embedded in people's daily lives. So they created, in a separate space, either through building it themselves, working as joint ventures with entrepreneurs, or buying companies as well. They created a set of ventures that were all platform businesses in areas of people's lives, buying and selling cars, buying and selling real estate, entertainment, healthcare. They do one of the biggest telemedicine platforms in the world. Because they said, we want to get into people's everyday lives, because insurance, people buy it, they die, and they don't do very much in between, or they have to get it for the car, and then they wait till the year's up before they renew it. So they created these ventures that allowed them to get into those spaces, people's everyday lives. They had a single sign-on for the bank and all of these, and then they suddenly, to your point, Ville, they collected huge amounts of data. And then they embedded insurance and banking services into those platforms, their own platforms, even better than doing it into a third-party platform. They created this integrated ecosystem, and that catapulted them to be I think they're now the 7th biggest or most valuable financial institution in the world. And no bank has done what I've just described there, where they have all those capabilities to do so. I'm not suggesting, it needs to be different in different situations, but that the fundamental, the boldness of the statement, we're not a bank or we're not a financial institution, that created, that created the space for this to exist. Then the structure in which these new ventures could be created, working with external entrepreneurs, giving them stakes in the ventures, much better than doing CVC investments, because you can't control them. It's your business, but you don't run it. You get someone else to do it. You take a stake. That creates the incentive, and then you incorporate it later. So there's a lot of good lessons that can be learned, but it does take that leadership, from the person at the top saying, we've seen how Alibaba and Facebook and Google operate. We are going to try and learn from that and apply it to ourselves in an effective way. But I'm not seeing at the moment, any banks or insurance companies doing that with that boldness that I've just described.
Okay, I think I can mention a few that seem to be stepping in that direction. DBS is one of them. SBI with Yono is another one, in India. So we're starting to see this rising up. You're absolutely right. There are some outbreakers that are coming along and demonstrating the art of the possible. But guys, we're starting to run out of time. There's been a fantastic discussion. Simon, we have a tradition on this podcast to always have a good but bad joke. And for season 4, we've decided to give that honor over to our guests. So I'm putting you on the spot here now as we start to sort of calm down and ease off on this episode of a fantastic discussion. Do you have a good but bad joke for our listeners?
Yeah, it's a very bad one because it illustrates a lot of the points that I mentioned. I was going to say my £25.82 rewards after 34 years of NatWest is probably, actually that would probably do, but I'll just sort of build on that. It's with NatWest as well. So, but this you could apply. You could swap out NatWest with nearly any incumbent bank, I have to say. So my wife was setting up a new business and needed a business account, and she tried to go for NatWest. She's been with them for over 30 years as well. She had to fill in it was all online, pretty good. She had to give them lots of information about herself, although she's been there for 30 years.
Yeah.
And then she pressed the button submit. She never heard from them. So she calls them up and they go, oh yeah, we can see it in the system. Just wait and a few days and you'll get a notice back. Nothing. Called up again. Yeah, we can see it in the system. Then I've had enough of this. She went onto the internet, went to Tide, which is a neobank for small businesses. 20 minutes, she had her business bank set up. So the joke is how crap the traditional incumbents still are compared to the startups.
I wish that was a joke.
You're absolutely right, Ville. It's a horrendously bad, true joke, right? It is. But then, I'm not going to make any excuses for the banks. I don't have to. That's your domain, Ville.
We always try to do better.
Yes. Everyone can always try to do better. Yeah. And it doesn't necessarily mean that the fintechs have got it all right as well, right? Sometimes you speed things up too much and it means that you remove some of the elements that you've got in your processes that ensures that you are secure, safe, and can give that level of trust, right? Sometimes it's not just all about speed. It's also about demonstrating that you can be trusted in the big picture.
And in the bank's defense, if you compare that process from 10 years ago, the banks probably kind of increased their pace with 80%. It doesn't mean it's still fast, but it's improved. So again, it's just a matter of perspective.
I
think I just leave you with my final stat, which is quite instructive, I think. There's a survey done of US banking consumers last year, which asked, how satisfied are you with your current bank? And 86% of consumers said they were satisfied or very satisfied. So you think, well, pretty good, 86% satisfied. But the same consumers said that the banks satisfy only 1% of their financial needs. Because what they actually need is help in working out how to use debt, how to plan their money, how to make how to make decisions on big purchases. A whole load of 99% of their financial needs are not related to keeping my bank safe in a big vault, which is what they rated their bank as good at. So that is a massive market opportunity. And for fintechs, for startups, and for other brands, and embedded finance enables those better placed to serve those customers to fill that gap.
You just hit another one of my hot spots there, Simon. I have a deep passion around financial literacy and the lack of financial education to our younger generation, particularly as things move more and more into digital, more and more gamification and social influencing. There is a higher need for the next generation to really understand how to manage money, not just 1 + 1 and what is cash, but actually how to make those fundamental decisions that impact their financial life as they grow. But we have run out of time, unfortunately. would love to have a longer discussion. And actually, now that we're moving into financial literacy, we could go on for another hour. But Simon, it's been fantastic to have you here with us. I think it's been a great discussion. Before we close out, Ville and I would like to give you the opportunity to, one, just very quickly promote the new Growth Playbook, but also give our listeners some insights into where can they get in contact with you, what's the best way of reaching you, and if they want to engage on the Growth Playbook, how do they do that?
Yeah, so the best way is, follow me on LinkedIn. That's a really good way of connecting. The New Growth Playbook is an online course about platform business models. So people can just go to newgrowthplaybook.com and you can access it and watch it at your leisure there. And then my current passion project is I created a new brand called embeddedfinance.io. So embedded-finance.io. Again, you'll see it on my links. And that's where through which I do my advisory work to companies, either financial or brands, and helping them move forward in this space. So that's my big focus at the moment.
Fantastic. Excellent. Thank you very much. And thank you very much to our fantastic listeners who have stayed with us through this episode and actually been with us since we started over a year ago now. If you're enjoying what you're listening to, please hit that like button, hit the subscribe button. We would really appreciate you. As always, if you would hop over to our YouTube channel, if you're not already there, hit the subscribe button and like button. And even more importantly, whatever platform you're on, leave us a comment. The algorithms love comments. Tell us what you're thinking of the podcast. Tell us what you would like to hear about in the future. Have you got recommendations on subjects, guests, or anything else? Just give us those comments, even if it's just a good thumbs up, guys. This has been Fintech Daydreaming. Thank you for joining us. Ville and I will be back in 2 weeks' time with another fantastic guest. Until then, this has been Fintech Daydreaming.
This is Fintech Daydreaming.